Hello, I am Peter, and I am so excited to talk about the incredible power of prepaying your mortgage. So, if you have a mortgage, this might be a really valuable session for you. Now, I do want to say that what we're talking about here are some confusing topics sometimes and confusing concepts. And so, I'm going to do my best to take it slow and really dive into the details. So, I don't expect you to really grasp every detail here, but I just want to get some of the concepts through today, if that's possible. So, the first thing we're going to talk about is the dream of home ownership, right? A lot of people consider that the American dream, to have your own piece of property, to put a nail in the wall and to make it your own. And the way we typically do that is through a mortgage. And so, I'm going to talk about how we can maybe accelerate the ability for us to really own our home completely by paying off that mortgage as quickly as possible. So, what I'm going to talk about today is how we usually use mortgages, a traditional way that we finance homes. I'm going to talk about how the payment that we pay each month is constructed, because that's going to really be the key for us to understand what our options are to accelerate that equity. And then I'm going to show you exactly why paying extra is so powerful, regardless of how much extra you pay. And then I'm going to give you some concepts, some ideas of how you might be able to pay more towards your mortgage to accelerate that pay down, to own your own home faster, regardless of what your financial situation might allow. Now, I do want to say here, standard disclaimer, I'll be talking about some services, maybe some websites, maybe some pricing concepts, interest rates, and all of that is just for illustrative purposes. So obviously, find a professional, explore your own personal situation, find the best products and solutions for you. The other thing I'm going to say here is I'm really only talking about the mortgage, the principal and the interest. I'm not talking about property taxes, homeowners insurance, private mortgage insurance, maintenance, repairs, association fees, all of the other expenses that we typically pick up when we own a home, right? I'm only going to be talking about the mortgage. So understand there are a lot of other things that might go into the consideration bucket for you as you're thinking about how much can I pay and when can I pay it, but really just talking about the mortgage. So first, how do we typically finance a home? When you're looking for a home and you find a great home, or you decide you're on the homeowner path here, what we typically do is we go to a mortgage broker or a banker and we get a loan. Now, I'm going to talk about one type of mortgage in particular, and it's one of the most popular ones. It's the 30-year mortgage with a fixed interest rate. And that means that you're going to make equal payments over 30 years. The interest rate is fixed, so the payment will stay exactly the same. And if you make all those payments on time, you will pay off your mortgage after the 30th year. There are some other types of mortgages, adjustable rate mortgages, some shorter and longer mortgages. I'm not going to talk about that. So we're just going to use one example throughout the whole presentation today, just to make it as simple as possible. So let's talk about this 30-year fixed mortgage. And the example I'm going to use here is $150,000. So let's say you borrow $150,000 towards a home, and we're going to use just a nice round number. 5% annual interest is what they would charge you for that mortgage. And this will be a 30-year mortgage. So it's going to last the 30-year period. You're going to make regular, even, equal payments over that 30-year period. And this is what that schedule looks like. So if we look at this graph right here, and we see that if I started this mortgage on January 1st of 2020, 30 years later in 2050, it would be paid off. So we would make monthly payments all through those 30 years. And this blue line here represents what that loan balance will look like over time. So as you can see, it curves down, but generally all we think about is making that monthly payment regularly. And then after the 360th payment, we will own the house free and clear. All right, in this example, a $150,000 loan at 5% annual interest over 30 years means that this mortgage is going to cost us $805.23 a month. That is going to be our regular monthly payment to paying off this mortgage. And I'm going to use this example throughout the presentation today. So what we use to figure out what each of those payments are going to be, and the monthly payment here, is what's called an amortization schedule. And an amortization schedule is pretty simple. It is like your coupon book. It is the payment that you will pay every month. So it's the loan amortized over a certain period of time. In this case, 30 years, 360 months. You'll have an amortization schedule for any loan repayment. So if you go get an auto loan and that's financed over 4 or 5 years, they will tell you what that payment is going to be. That's what an amortization schedule is. So it's the exact schedule of those payments and what the balance will be after each payment. And so it will look something like this, right? This is just done in a spreadsheet, but this is the monthly amortization schedule. And if we were to take this loan and start it on January 1st, 2020, the payment is $805.23. And part of that payment will be interest, and part of that payment will be paying down the principal. Obviously, we want to pay down the principal. The principal means the actual remaining balance owed at that point, right? And so as we pay down that principal, obviously, after 360 payments, after 30 years, that principal will be paid down to zero. The following month, we will have another payment, and part of that will go to interest and part of that will go to principal. This is important because what I'm going to show you later as we are paying extra, what that does to those payments. So at this point, just want to have you understand that the concept here that we make a payment, some of it goes to interest, some of it goes to principal and mortgage. Now, how would we calculate this? How would we say, hey, I'm going to borrow this amount of money. What's my payment going to be? One way you can do it is go to mortgagecalculator.org. There are a ton of mortgage calculators out there, and you can calculate this and see not only the monthly payment, how long the loan will last, but you can get this exact amortization schedule. And let's just go there and take a look at it right now. All right, so I'm here at mortgagecalculator.org. And what we can do here is if you go down here and scroll down, you can put in the home value. I'm going to actually put in the loan value here, $150,000. I'm going to assume we owe that whole loan, so I'm going to have no down payment. The loan is going to be $150,000. I'm going to change the interest rate to 5%. The loan term is 30 years, and I'm going to set this up just like we talked about to start in January 2020. I'm not going to do anything on property tax or PMI or homeowners insurance or homeowners association. And this is going to be for buying, and it's going to be conventional. I'm just going to say the credit rating here is excellent. And what we will get here is that chart that I showed you a little earlier. And this shows you starting in 2020, what this principal balance will be, that dark blue line, all the way to 2050 when we pay off that mortgage. Now, if I go down here, scroll down, what you can see right here is all of the details about this loan. $805.23 is going to be the monthly payment. You can see here, we have the loan payoff at the end of 2049. So by 2050, we'll be totally paid off. Now, what you might say is, where's that amortization schedule, Pete? And so what you can do here is show the amortization table. And I want to go to show the monthly amortization table. And I'm going to go ahead and click calculate again. And now when I scroll down here, it will show me every payment, the interest, principal, and then the balance. And so what you can see here is it breaks it down. There's going to be a lot of payments, 360 payments. That's a lot of payments that we're going to pay. And you can see here right at the end, right as we hit 2050, you're going to be down to your last dollar, right? So that shows you what it's going to take to pay off this particular loan. And I bring that up because if you want to really understand what the interest and principal is, you can generate these calculations online pretty easily. So let's jump back. How is that payment calculated? And I'm going to walk through this a little bit slowly because I think what's not always intuitive is that the calculation for how much interest you are required to pay is done basically at the end of each month on that loan. And so let's say we start this loan in January 2020, and we have borrowed $150,000. The interest due is going to be 1/12, the 5%. The 5% is what they're going to charge us for the year, but they're going to charge us 1 month's worth of that in January. And if you calculate that out, that's going to be a $625 interest charge. Now, we know that the monthly payment here is $805. So you're going to write a check, send that into your mortgage company for $805, and they are going to say, hey, you owed us $625 in interest. So we're going to pay that interest back. And then all of the excess, in this case, there's an extra $180 in your payment. They are going to apply that to the principal balance. So now your $150,000 balance becomes $149,820. So you've paid off some of that balance at the end of the month. Now, let's go ahead and look at the next month. So another month goes by and you're about to send in your payment and your bank is going to charge you some interest. And now they're going to say, hey, now you only owe us $149,820. What you can see here is that this balance here is what remains after January. And so they're going to calculate the interest and it's going to be pretty close, $624, so slightly less. You're still going to send in your regular monthly payment of $805. And they're going to do the calculation of after they've paid off the interest, how much will go to principal. In this case, $181 of your payment is going to go towards that principal balance. And now you only owe $149,639. So you can see here, the beginning of February, the $149,820. And at the end of the month, it's going to be $149,639. This is how it works. And then every month, the calculation happens over again. New interest amount is calculated. The payment comes in, They pay the interest, they apply the rest of principal. And so this is 2 months out of 360 months. Now, one thing I want to show you here, which is interesting, is you have sent in between January and February 2 regular monthly payments, $805. So you've sent in now $1,610 worth of payments. But if you look at what the current balance owed on the loan, $149,639, the loan balance has actually only gone down $361. So you've sent in $1,610 and you've actually only reduced the loan by $361. Now, why is that? That's because the interest is a large piece of the payment at the beginning of the loan, right? $625 in January, $624 in February. And so you've actually sent in quite a bit of money and you haven't necessarily paid down the loan very much, all right? So I think that's one thing to keep in mind as we look at this. So now that we understand how each month's payment is calculated and how much of the principal you pay down, we can look at this amortization schedule one more time here. And now I'm going to populate in the amount that goes to the interest in each payment and the amount that will go to the principal in each payment. And if you look at this, what you'll notice is that the interest goes down and the principal goes down, but they're pretty close, especially at the beginning. And if you add up all these principal payments over 360 payments, that will equal the $150,000 that you owe back against the principal, right? And then the interest will just be paid back to the bank. This is the charge for borrowing this money, 5%. And so now we can look at any payment, right? On our first payment or second payment or 10th payment or 15th payment or 20th payment, and we'll know exactly how much is going towards interest and principal. And I bring this up because this can be really helpful if you want to be very strategic about how you're going to pay down your mortgage quicker. All right. So let me just break this down for you. I only showed you like the 25 months or so of payments. Let me just summarize what will happen over the 30 years, over that 360 months of payments for you. So you're going to send in $805 a month for 360 months, 30 years. And what you're going to end up paying is $289,884 for a $150,000 mortgage. What this means here is that, yes, you've paid back that $150,000 that you actually borrowed to buy the house, but you've actually paid an additional $139,884 just in interest. And there's actually a saying that once you've bought your house, you've also bought the bank a house. So that 5% interest doesn't seem like a lot in each particular year, but it will really add up because the loan extends over 30 years in this case. So I want to break up two concepts here: interest rate and the amount of interest that you'll pay. So your interest rate is what the lending institution will charge you. In this case, in this example, it's 5%. And the amount of interest, that $139,000 of interest, is the amount of interest that you'll pay, right? So how do we reduce how much we'll pay? One, you can get a lower interest rate. So if you can refinance or when you're shopping around, take a lower interest rate, that's great. But I think in most cases, most people will get the best interest rate they can all the time. So if interest rates go down, many people refinance. When you're shopping around, most people take the lowest interest rate. So that's really not an area of opportunity to reduce the amount of interest you'll pay. So then you're saying, how can we take this $139,884 of interest that I'm going to pay, make it as small as possible, and pay off our loan as quickly as possible? So let's get into it. How can we pay less total interest? And what I want to do here is, instead of talking about the mortgage, I want to talk about a really simple loan here, right? Just to drive home a specific example of how principal payments work. Let's assume that you come to me and you wanted to borrow $100 from me, and I give you a $100 loan, and I'm not going to charge you any interest. We're going to keep this really simple. Just pay me back the $100 over the next 5 months. Pay me $20 a month for 5 months, and you'll pay me back that $100. So what does this look like? So if we're starting again in January and you want to pay just as agreed, exactly as you're scheduled, you're going to owe $100 and you're going to make a payment in January of $20. And then you're going to owe me $80 left. I'm being very, very simple about this because I don't want to complicate it with interest right now. And then in February, you're going to pay me another $20. In March, you're going to pay me another $20. In April, you're going to pay me another $20. In May, another $20. And so after 5 payments equaling $100, that loan is completely paid off, right? So really simple example. Now let's talk about, what if you made one extra payment? So now you still owe me $100, but instead of making a $20 payment, you say, hey, I have the $20, but I also have another $20. So, Pete, I'm going to pay you $40 in January. That's more than it originally scheduled. And what that means is now you're going to actually owe me $60 in February. And then if you say, hey, I want to pay you just as we agreed, I'm going to pay you $20. Now you're owed $40, and now you're going to make another $20 payment, and then you're going to be done in April. So after 4 months, you're going to pay this loan off. So what you've done here is you've paid one payment early, and you've reduced the number of payments that you have to pay, right? Really simple. You've paid 2 payments essentially in January. And so now instead of 5 months to pay off the loan, you're going to pay it off in 4 months. And the same thing happens. Let's say you make 2 extra payments. So you owe $100 in January. You say, hey, in January, I've got some extra money. I'm going to pay an extra $20. So that leaves you $60 balance in February. And you say, hey, February was a pretty good month too. I still have some extra money. So I'm going to pay a $40 instead of just the $20 payments. And now you only owe $20. And so in March, you can pay that $20. So now you've paid an extra payment in January, an extra payment in February. So you've prepaid 2 months of payments, and you've shortened the loan by 2 months as well. So really simple concept. 1 extra payment means the loan is 1 month shorter. 2 extra payments means the loan is 2 months shorter. And I bring this up not because it's really simple, but because the key here is that you're making extra principal payments. So how does this apply to a mortgage? How your monthly payment works is that if you just pay your amortization schedule as scheduled here, $805.23 a month, you are going to make 360 payments. But let's say right here, I actually decide in month 1, I'm going to pay the $805.23. But if I look down here, what do I have to pay to get rid of this next month's payment? All I actually have to do is pay the principal due. So if I were to pay $805.23 in month 1 and include an extra $181, I'm actually taking care of the second month's payment. And so that reduces my payments by 1 month. So now I only have 359 payments. Now, when I get to month 2, I'm still going to send in $805.23. But I would say, hey, if I want to pay the next month's payment early, all I need to do is add another $182. And that would eliminate this payment. And that would bring now my mortgage down to 358 total payments. So the key here is because interest is calculated at the end of the month, all I have to do is add the principal for the following payment to eliminate one payment. Just like in the previous example, my payment for next month was $20, but there was no interest on it. So if I pay an extra $20, I get rid of that payment. Likewise, for a mortgage, if I prepay the principal due in the next payment, I eliminate that payment, right? So we don't have to really think about what the interest charge is for that payment. We're just eliminating that payment total. So we'll never get charged that interest. All right. I know it's a little bit of a muddy concept, but that's where if we take a look at how much we need to add to our current month's payment, it's really quite a bit smaller sometimes than a lot of people think. That sometimes they think that they would have to double the payment to eliminate one payment. You don't have to do that. All you have to do is include the principal from the following month. Now, let me just give you some examples here. If you pay this mortgage as scheduled, yes, we know that it's going to be 30-year mortgage. But if you were to take an additional $180 every month and add it, as an example, to every payment, you don't even look at the next principal amount due on the following payments. You just say, hey, I know that $180 will take care of the next month. I think I can afford that. I'm just going to add that to my $805 monthly payment. What that'll end up doing is it'll pay off your mortgage 10 years early and reduce the total amount of interest that you're going to pay by over $51,000. So if you just pay $180 a month more on every payment, you will actually have a 20-year mortgage instead of a 30-year mortgage. Now, if you were to double that, let's say add $360 to every month's payment, I know these are larger numbers, you would actually end the mortgage 15 years early. You would actually cut it in half. So your 30-year mortgage would become a 15-year mortgage with $360 extra each month. And you would save yourself over $74,000 in interest paid. Now, I think a lot of us just ballpark it saying, hey, if I wanted to cut my mortgage in half from 30 years to 15 years, I probably have to double my payment. And what I'm saying is that you don't actually have to do that. In this case, an $805 payment add in $360 a month would cut it in half. In fact, if you were to double your mortgage payment, so instead of $805, you would pay $1,610, you would reduce your mortgage length by 2/3. It would become a 10-year mortgage instead of a 30-year mortgage. So pretty powerful stuff. And you would save yourself quite a bit of interest. So if you could afford twice the mortgage on a regular monthly basis, you'd only have a 10-year mortgage. Pretty amazing. Now, I know that some of those numbers are pretty extreme, and a lot of us would say, hey, I can't afford to pay that much more on my mortgage. And some of you might have a larger mortgage. So I want to give you some alternatives, some ideas and some concepts to consider here that might be a little bit more palatable. One alternative is the rounding up, and the other one I will call the biweekly payment. So let me explain what I mean here. So rounding up means, in this case, the payment is $805. Now, if you just rounded this up to $900, which again is a pretty big leap, but if you rounded it up to $900 and you said, hey, instead of $805, I'm going to pay $900 for the length of this loan, what you would do is you'd reduce your loan duration by 6 years. Instead of a 30-year loan, now you'd have a 24-year loan. And you would save yourself over $33,000 in interest. So pretty powerful stuff by rounding up to the nearest hundred. Another option here is the bi-weekly payment. So every month you owe, in this case, $805. Now, a lot of us get paid every other Friday, so every other week. Some people get paid twice a month, but for a lot of us, it's every other Friday. If you were to get paid every other Friday, and you were to say, hey, on every paycheck, I'm going to pay half of the mortgage, in this case, $402.50. So I'll pay it on the first Friday, and then I will send in the second half of the mortgage payment, $402.50, when I get paid in the second paycheck. In most cases, you would pay that $805 mortgage payment, so you'd be just fine. But because the biweekly payment actually means that in a couple of months a year, you actually have an extra paycheck. So some months have 5 Fridays. And so you'll actually have 3 paychecks. So you'll have an extra paycheck. So what will end up happening is in those months, you'll actually pay an additional $402.50. Now, that means actually some pretty impressive results. 5 years early, you'll go from a 30-year mortgage to a 25-year mortgage, and you'll save yourself over $25,000 of interest paid. So if you just pay it with every paycheck biweekly, that's a pretty big impact too. Now, what if you took both of these strategies and did them together? So if you could round up and do biweekly payments, in this case, if you rounded up your $805 to $900 a month, and then you split that $900 a month into your individual paychecks, so $450 per paycheck, what you would end up having here is 9.5 years cut off your mortgage. So a 30-year mortgage will go to a 20.5-year mortgage, and you would save yourself almost $50,000 in interest, which is pretty incredible too. I think much more bite-sized, right? But the reality is you don't have to abide by any of those. And if you can send in more money whenever you can, that can really help. In some months, maybe you can only pay what you can pay as just required payment. And in some months, maybe you can throw in some extra money. But let's say you could afford $45 per month. So if you could round that $805 payment up to $850, what you would do is you reduce your mortgage by 3 years and save yourself $18,000 in interest. So a 30-year mortgage will become a 27-year mortgage just by rounding up to $850. But it doesn't matter. Even if you are just by and paying your mortgage, if you can throw in an extra $20, an extra $50, $10, $100, whenever you can, it will have a big impact for you. And then when you do send in an extra payment with your mortgage payment, what it's called is curtailment. So what you might see on your next mortgage statement is if you send in an extra $50, they might say $50 curtailment, principal curtailment. That's how they identify it on your statement. And that goes right towards the principal to help pay down that loan faster. Now, you might say, hey, okay, I can figure out my amortization schedule by going to a mortgage calculator. But Pete, how do I figure out what effect my overpayment will have? There's some really good options out there. Carl's Mortgage Calculator is a really nifty site. They have a webpage at drcalculator.com/mortgage. There's also an app, depending on your smartphone, which you can go and enter some numbers. And I want to show you this quickly here at drcalculator.com. So here I am at drcalculator.com/mortgage. And what you can do here is, it's a little dark, but you can use these sliders to set up your mortgage. So I'm going to slide it here to $150,000. And I'm going to use the slider to get it to 5% interest, which is what we're illustrating. The number of years here is 30, so 360 months of payments. And what you can do here is if I look right here, now I can see $150,000 loan, 30 years, 5%. This shows me the payment. And down here, if I go down to these tabs, I can go to prepayment and I can add in some additional monthly contributions. So in this case, even if I added $100 a month and I wanted to start this on month 1, what this would do is it'll show me how much of my mortgage would be reduced. So in this case, sending in $100 extra a month would reduce my mortgage by 6 years and 5 months. And I would save $34,605 in total interest. And so if you wanted to play around with this, say you wanted to send in $50 extra a month, it would show you, hey, that would reduce my mortgage by 3 years and 8 months. So this is a great place to just play around with things. Maybe you can't send in a monthly prepayment. You might want to go down here to an annual prepayment. Maybe you get a tax refund or a work bonus. You could put in $1,000 and do that once a year. And again, it will show you what effect that will have on your mortgage. So a really fun tool to poke around with. So hopefully you can see how powerful sending in any money is to paying down that principal. So you can kind of get ahead of those interest calculations. And even if you can't do a lot, you can actually make a big impact on not only how long your mortgage is, but how much interest you'll pay over time. So prepaying what you can and using some of these strategies might make a big difference to get mortgage free earlier. So hopefully that's helpful to you. Thanks so much for joining me.